Well, there's very strong arguments from the bulls and from the bears. Look, there's no doubt about it. And I've just noticed, look, I have been on holidays, but at the same time, I've seen clients, I've spent some time on the Mornington Peninsula seeing prospective clients and existing clients, and confidence still isn't there to the extent that I would have thought. People want to see these interest rates come down.
Right.
And that's, they're just sitting there, waiting. But that confidence just isn't quite there to the extent that I thought it would have been. We've had a good rally.
Yeah.
Probably surprisingly strong rally. It's not surprising it's come off a bit, and I think it's quite healthy that it hasn't sort of really corrected. It's just it been easing back. Yes, Australia's been a little bit weaker on look at today, but I think that that confidence isn't there to the extent that I thought it would have been, and I think people. A lot of people have been asking me, but where's the correction? And I think when I spoke to you last time, they don't realise there has been a correction in this market, as Jamie Nicol from DNR pointed out to me, but it was in bond markets, and it was a capitulation in bond markets.
It's really interesting because we had that Westpac consumer sentiment today, and it's at the lowest levels. It's going back to the recessions, the deep recession, late 80s, early 90s, which is really, really bad. Yet you've got this conflicting reports of people rushing out to, some of them wanting to buy property because they think rates are coming down, and then the others saying, oh no, it's a terrible time to do that. So maybe there's true confusion about this whole narrative of inflation being sticky and central banks having to do more, having to make life tougher for a bit longer.
And I think people are, look, there's no doubt that they talk about the long-term effects of the interest rates and the time it takes to flow through. And I think the man in the street is hurting. Like, again, on the Mornington Peninsula, I was at a restaurant on Sunday, and I just pointed out to people after being there, after half an hour, I said, this place is half full.
Oh, interesting, interesting, yes. So there are, let's say, anecdotal evidence that even at the top end of the market, which you are seeing overseas with some of these high-end sales for the luxury brands, they're seeing the consumer pulling back. So that probably augurs quite well then when we look at central banks being able to drop rates.
Correct, and I think that's where this hesitation is, that difference, and it's a confidence factor. And they're looking too much at the economy without appreciating that markets look ahead.
Yes, yes.
And I think that's where this sticking point is.
Yeah. How important is geopolitics in 2024? Because I read a really interesting post from Victor Schwetz, and he says, yes, there's more geopolitics, but central banks now are far more adept at moving quickly should you have these, let's say, systemic crises.
Yeah, look, I think you and I were brought up with the fact that these things provided buying opportunities. When you had conflicts like the Iraq invasions, etc. There's no doubt they affect and have affected the energy markets as well, and that's something where it's just been bubbling along. I think people are sort of looking at the US. What will happen if you got a Trump presidency, and I'm not here to say what the president who will win the presidency, but I think the thing that has happened in the world compared to the previous 30 years, and I think this is something I think Victor would also appreciate and comes from, is the fact that there was this globalisation for 30 years. Now the world's split probably in two, the China camp and the US camp. And we can go through, it takes too long to go through and work out who's in each pocket. I think in the US, the US camp's far more diverse though than those in the China camp. But the world has split, and we've seen things like TSMC going with respect to building manufacturing plants in Europe, in the United States, in Japan, etc. Whereas previously this globalisation was centralising everything. So the world is has become a very different place, even since COVID.
Absolutely. That really then focuses in on the Mag 7. I mean, they were spectacular. Tesla obviously losing a little bit of its shine. Question marks around Nvidia continuing to trade into its valuation. Mind you, it's only on 26 times. I think people forget. But they're very global stocks. They're dealing with lots of pushback from politicians in certain areas, plus navigating China. Is it a case, if you take a blanket approach there, that might be the wrong investment decision?
Look, there's no doubt these things surprised everybody in 2023, and as one of your other guests, Alan McFarlane, pointed out, a lot of these companies are bigger than the Australian stock market.
A lot bigger.
So yeah, and there's not just one or two. Yeah, there's a few of them that are, and yeah, that's a surprise in itself. But I think what I'm looking for in 2024 is there are in the S&P 500 another 493 stocks. In October, we're probably a little bit early. We went into mid caps, and yeah, they had that final sell off for about a month before they started rallying, and that was quite severe, 7 or 8%. But I think that part of the market is very undervalued, both here in Australia and offshore. And I think that you will see a broader rally, but don't discount. These things they're amazing companies.
Yes.
And AI is for real, and it is transformational. Like previous technology before it. There's some that you can just shrug your shoulders at, but AI is for real. There's no two ways about that.
Can markets rally purely off the back of interest rates coming down, or are earnings going to have to hold up at the same time?
Don't be surprised if there are a few earnings shocks at the moment. I think interest rates will give you that first phase. Earnings and then projections on earnings is going to be the second phase. I was listening to a podcast coming up today, for instance, talking about US reporting season and the 4 big banks, and there's 989,000 employees of the 4 big retail banks. Now, as they were saying, there will be less employees, but you're also looking at growth in that sector. So that growth is going to occur with less. And again, we were just talking about AI. That's one of the reasons why.
Absolutely. The bank's really interesting because there is a view out there that if you do see a re-steepening of the yield curve, that's going to be really positive for the financials.
Yes, I think Australia though also has probably some more unique issues that we have to deal with here. So let's divide them in two. Again, we're talking before about the world's divided a little bit. I think yes, you're right with respect to the US, but in Australia, perhaps you're going to see some of those insolvencies to a higher extent. You're also seeing net interest margins in Australia coming under a little bit more pressure, whereas I think it was Jamie Dimon who reported the other day that JP Morgan's was at a record level. So quite a contrast there.
Absolutely. So just remind us in terms of where you're sitting in terms of your asset allocation compared to the benchmarks.
Yeah, so we're overweight. We are market weight, developed market equities, emerging market equities, but the bias on developed market equities is to go overweight. So we're looking at that point. And if we see this retracement, I think that move's going to occur. We're underweight Australia. We think there's some headwinds here in Australia that other markets don't have. We are overweight diversified credit, but outside of the property sector. We're overweight infrastructure as well. Market weight private equity. Property we're weighting. In reality we're actually underweight. I think there's some reasons where we can just sit and wait. So where we are overweight is in fixed income, if we look at the more defensive sectors. But I actually think that, look, I've never been a long-term fan of bonds, and I think when you sort of see some of the short-term yields you can get, I think at a more conservative level, if we saw bonds rally, as I think we will, I'll be reducing that exposure and going sort of more where I know I can cash in that 6-7% rather than looking at the volatility in bond markets.
Right, so you're talking more towards corporate bonds in that perspective, or you're talking, okay.
So I'll just be, I'm sort of thinking further out here on how we would play that. But I think, look, we've made money out of bonds, and I think you will make money out of bonds this year.
Interesting. So before you go, now Australia, that CPI print looked like it was a bit better. I mean, it's all a bit of a moving feast though, isn't it, at the end of the day with these CPI numbers. But scope for the RBA to potentially start cutting rates this year?
I think it'll be further out though. Other market, you're going to see other central banks cut before the RBA. I've seen some talk, bringing it forward to about August. We were probably looking October. Let's see. Yes, we will see a cut. We're still only looking at one cut. You're looking either side of the end of the third quarter calendar year. Yes, that CPI figure was, look, it was a good figure, there's no doubt about that. What surprised me was actually the way the market didn't react as positively as I thought it would. In fact, from memory, the market sold off that day a little bit. Yeah.
Market's very low, liquidity at the moment because everybody's basically still coming back from the Mornington Peninsula. How much of a headwind for Australia is China's recovery, and also looking at that sort of resources sector, and also briefly you touched on the financials, the banks.
Yeah, look, let's start with the second part. I think they are being the large weighting they are. I think that is. They are going to be a drag on this market, the banks. I think that's the first thing I think I've got to put out there. The second thing, though, it's interesting. Capital economics. They've been talking more positively that you're just going to see a little bit more growth in China than perhaps the market was looking at. However, they've got darker clouds out there next year, 2025. It's amazing we're talking about that already, but. And we do have a GDP print for the fourth quarter this week, but just slightly, a little bit more optimistic than perhaps a lot of the doomsayers are, because there are a lot of people that love to hate China, and therefore where they're seeing that supportive is a little bit more supportive in the Aussie dollar.
Overall, you sound reasonably upbeat for this year.
I am, yeah.
Cool.
And I think that as I've been saying to people, this will be a year you will get rewarded for being in equities. I don't think it's going to be bumpy, and diversification is going to pay off. But the number of people that are sitting there in TDs at 5%, I think you'll be rewarded for having them outside of TDs at 5%.